Hi everybody and welcome to this live webinar. So anyway, I will start with today's webinar. Okay, I will try to find the link later and post it at the end. We are going to do just one chart in order to the webinar have something else to see while we are looking at the charts, right? As we are talking. So you know that the charts formations of technical figures are just a couple of more than a couple, a series or a different number of candles, okay, that trying to draw some kind of figure in the market, and we can understand and interpret that figures and use them for trading, right? So we have different kind of figures, different kind of formations. They are mostly classified in two major groups, okay, the ones that involve a trend change, okay, and the ones that understood as a trend, the ones that are understood as a trend continuation figure, okay? There's a third category for those figures that doesn't get into these classifications because of their particular characteristics, right? And the idea today is to talk a bit about trend change formations, and we could continue with the continuation formations later. The fact is that what I call continuation figures that we are going to talk in next webinar, right, are the mostly triangles, right? And all the different forms, triangles, hat, pennants, flags, wedge, etc. So, and we could find out that some authors don't consider them trend continuation formations, okay? But at least for me, I understood them that way. Anyway, we are going to talk a bit about the ones that means a trend change, okay? We have some examples to talk about today. We are going to try to find them all and see that most of these different figures, right, can be seen. We are going to use big charts today for examples, mean dailies or weekly ones, because they are always have the stronger signals, right? But we will find out that we can also see some kind of just figures, even in 1 hour charts, okay? Some pairs act better with this kind of formations, right? So we call the trend change formations the ones that occur at the end of the trend, okay? Either at the end of a bullish trend or either at the end of a bearish trend, okay? And they usually mean exactly the change of that previous trend, or at least a strong correction against that dominant previous trend, okay? The most common ones are the double roofs and double floors, triple roofs, triple floors, the head and shoulders, and the inverted head and shoulders, right? So we are going to discuss a bit how to understand these figures, how to interpret them, and how reliable they are, and where to place our stops, where to place our limits, etc., etc. Yes, patterns, Boyke. Sorry. You know, I have my English issues, but I guess at the end you all understand what I mean, right? Maybe I was starting a bit today talking about the most common figures that. Now let's start with the double floor, okay? And for that, okay, we are going to move to dollar transition. Okay, please let me know if the chart is okay. I know that yesterday at the Live Daily webinar, I have some issues with charts. Charts were not refreshing right. Okay, so please confirm me that you are seeing the dollar transition daily chart. Okay, it's okay. Okay, thank you. Yes, okay, thank you. Well, anyway, we are going to talk a bit about a double floor, okay? And what does a double floor mean? It means that at the end of a bearish trend, okay, we will find two relative minimums at the same level, right? Mostly, we could have a couple of pips difference, mostly if we are talking of daily charts, okay? Could have 10 pips, 15 pips, even difference between one and another. But the fact is that when the pair reach this 8710 zone, right, in daily charts, right, we have a spike up and then fail to break another second attempt to reach that level, fail to break, okay, that would form the double floor, okay, that's the formation of the figure, right? Okay, and of course, this kind of formations means bullish correction, right? But remember, it has to be at the end of the bearish trend, right? I can talk about a double floor, I don't know, maybe here, right? Because we are not at the end of the bearish formation. It's just an example, okay? Different if we are looking to 1 hour charts and we are talking of intraday, right? But in this case, remember that figures are stronger when they are at the end of an annual trend. So what is the other characteristic of this figure? Well, we have a spike in the middle of, that forms the neckline, right? This is the neckline of the figure, okay? This 94.40, 94.60 area, okay, seems to be the neckline of this figure. So how do we trade this? How many pips we could get from this figure, and where do we place our stop losses? Well, of course, the number of pips will depend on the number of the charts we are trading, right? But with these two minimums of the same level, and of course act as support, and this intermediate point, the neckline, we know that when the neckline is broken, the formation begins to appear. Okay, the formation is complete once price breaks the neckline, and that happens here. Okay, in this daily blue long candle, right? I will move the cursor so you can see it clearer. But that's where the figure gets complete, and we have our entry to the market, right? We have two things to take care of. If the link leg is this 94.50 area, right, and we are talking of daily charts, okay, we could place a stop loss maybe around 100 pips and not more under that neckline, because an intraday candle could do such movement, right? But that's it, not more. Mostly in Japanese yen crosses, in Japanese yen against dollar, sorry. We know it's a pair that moves not that many pips a day, actually. Anyway, that's where we place a stop. And how we determine our limit? Well, we need to measure the distance between the neckline, okay, here, let's say 94.50, right, and the 87.10 zone, right, where we have the minimum, okay. The distance between the neckline, and that lows we had, okay, that's from the bottom. That's the number of pips this figure should accomplish in the future, okay? We are talking about 720 pips or so. If you take a look at charts when the pair reach the 140 area, the fact is that it failed for, I don't know, maybe 10, 20 pips, okay? That's the reality. But there's another thing we should take care of. Figures not always accomplish 100%. That's what I said about this number of pips is what the CEO said, okay? I do myself prefer to reduce that profit to 70%, more or less, right? Because, okay, we are talking to about 700 pips. Let's say that I will place my limit in, I don't know, 490, okay? 490 pips. That's the 70% of that 700 pips. And why? Because you can see, we all know that market never moves straight, right? So see what happened here. Fair break, make a good number of pips, but then attempt to fall, attempt to break the neck to the downside. Okay, of course, fail and continue to the upside, but we don't know what would happen here. Okay, we are looking at the past, and looking at the past is not the same as looking at the present or the future, right? So if you reduce your limit, if you don't attempt to go for 100% all the time, okay, you will find out that you will have more profitable figures, and and you will ensure your trades. Maybe the pair will run the 100% of the rally rate, but give the market that last part, okay? I know for experience that most of the time the figures accomplish at least the 7% of the figure, okay? Of the target, sorry, okay? So that's one thing we should take care of. Another thing important to mention of double floors is that they are very common figures, okay? And they are they have a high reliability, sorry, meaning we can trust in this kind of figures. Even if we are talking to 1 hour or 4 hour charts, we could see a lot of examples in 1 hour charts in GBP of double roofs or double floors. Okay, we will take a look at them later. But let me see if you are making. Okay, sound space. You lose. Okay, sorry, Boyki. I don't know what sound space. It's okay now. Anyway, back to, I'm closer to the computer. I don't have a micro. It's incorporated in the notebook. Anyway, another thing we should take care of, okay, is about volume in market. Okay, I always say this. Sorry, line white. Let me change color. I don't know why lines are white these days. Yeah. Okay, here we are. This is our neck, right? We call this our neckline. Okay. So another thing we should take care of is the volume behavior. Okay, during the different times of the figure formation. Okay, we usually say that the volume tends to decrease. Okay, when the price approach to the lows. It's not this the case. Okay, we have a very high volume in these two lows. Not the perfect case to see as an example. We are going to see another example, maybe a bit more accurate. But another thing regarding volume that is very important is that we need to see a strong high volume during the neckline break. And that's what we are clearly seeing in this daily charts. Okay, we know there are different indicators to measure volume. We always talk about this, but I tend to watch candles, right? When we have these long candles, okay, we know there's plenty of volume in this day in the market, okay, and when we have these small ones, okay, we can talk about lower volume, right? But we see that we need to see that when price breaks neckline, really accelerates, okay, and volume grows, okay, that will confirm our figure. In the case we have a pullback, okay, after the neckline break, not here because this pair hardly make pullbacks, right? We don't see the pair pullback. It made them pullbacks very often, not in this particular one, but in other pairs, of course, it happens mostly. Volume should decrease again, be lower, okay? Okay. Anyway, let's move to another figure. If we, okay, no, I don't know if I can turn it up, but I will talk closer to the machine, okay? I won't relax. Okay, anyway, another kind of figure, different for that technical double floor, is what we call a triple roof or triple floor, right? Figures are mostly the same. And that's something we could see in the double roof. We are going to talk a bit about double roof. That is mostly the same of that double floor, but of course it's at the end of a bullish trend, okay? And this is what we have in the daily charts in euro in the 160.20 zone, right? We do have there, okay, the same figure, right? The double roof in this case, okay? And the neckline should be around this level, right? Okay, these lows we have in here should form the neckline, and see how the pair accelerates and the bottom increase when the pair finally breaks. Okay, and of course never complete a pullback in this case. Okay, can you see it? It's more or less the same. We are talking about the charts. Okay, if we take a look at GBP, maybe we can find, okay, different formations in smaller time frames, like in this case. If we turn to a 4-hour chart, okay, we have here what we call a triple floor, right? It's the same, okay? This is a very common figure, okay? We have a triple floor here with 3 minimums at the same line. We have a neckline in the middle, okay? And a stronger volume acceleration when pair breaks above. And if you measure the distance, in this case, as we are talking about 4-hour charts, we have 70 pips, and of course the pair accomplished them in a couple of candles, right? And yes, we are at the end of a bearish trend, and that's something we should never forgot, okay? But mostly double floor, double roof, triple floor, triple roofs are more or less the same, right? Are exactly the same. The only difference is the distance, or not the distance. Where they are located, okay? If at the end of a bearish or at the end of a bullish trend, okay? The triple floor and the triple roof are not so common figures, right? They are not so common, but they are more reliable even than the double floors or double roofs, okay? See what happens here, okay? We are in a bearish trend, right? In the middle of a bearish trend, and we have kind of a double roof in the middle, right? But we are not at the end of the bullish trend, okay? We are in the middle of a bearish one. If we consider this intermediate minimum a neckline, okay, we can see that the figure didn't accomplish, okay, not even the 50% of the rally that showed. That means 190 pips, we get only 70 when the pair breaks the neck, okay? And why? Because this double roof is not it's not after a bullish trend, but it's after a bearish. That's something we should take very much care of. See the difference between bottoming at a floor at the end of a bearish trend and a top in the middle of a bearish one also is not as reliable in the other case. We could understood this as a double roof, okay? Meaning there are two highs at the same level, we have a neck. But the figure fails because it's not well located. It's not at the end of a bullish trend. It's in the middle of a bearish one. And that's makes the whole difference when trading figures, okay? Maybe we could consider this, okay? In this case, yes, we can consider this a double roof, okay? And maybe this is the neckline we should talk about. We are talking about another 70 pips, and the pair accomplished the 7% of that level, okay? But we are we are following a bearish trend, a bullish trend, sorry, okay? That's the difference. After bottoming, the trend changed and began to start trend bullish, okay? I don't know if I'm messing it too much, but I do believe that you understand what I mean in here, right? So, do you have any questions or comments? I will speak a bit louder. Okay, no questions, no comments. Is everything fine? You want to see another example? Or the point here? Yes, Boyki, I know you understand. You have been here all your life, all my life in FX rate, but no comments from anyone else. So, okay, we will going to talk a bit of another figure formations, right? We're going to see, let me find an example. I had a chart. Okay. Here is one of my oldest example of a head and shoulder. Okay, I have followed this figure for many long time. It's a figure coming from past November, December 2007, right? But this is what we call head and shoulders, right? Okay, we have a figure typical of bullish markets, okay, and of course when it's complete implies a bearish correction. It's considered a common figure, although not as common as double roofs or double floors, okay? And of course this figure is formed by three maximum zones, okay? The first and the last at the same levels, okay? Those are called the shoulders, and the one at the center clearly higher, okay, regarding the other two, called the head, okay? If we put together the minimums of this formation, right, around here, okay, we have quite a minimum zone there, the minimums, right, here and here, maybe we have a small spike here, but that's the minimum zones. Then we have our neckline, right? That's the neckline we have for this formation. When we're talking about a head and shoulders, like in this case, okay, not an inverted one, the ones that are at the end of the bullish trend, it's better. It has a slightly bullish slope, meaning second shoulder could be a bit more high than first one, right? The second shoulder could be, it's better if it's a bit higher than the first shoulder, okay? But second shoulder never can be under first shoulder. If we have a bearish slope in the like this, okay, of course not the case, but as an example, okay, if the second shoulder is lower than the first one, then the figure is not as reliable as if it's not really reliable, okay? It's reliable when the second shoulder is at least at the same level of the first one or at a bit higher, okay? So what happens here when price breaks the neckline, okay? The figure is complete, the formation is complete, and the bearish target would equal the high between the neckline and the maximum of the head. In this case, we are talking about 3,100 pips, right? And well, that's what the pair accomplished in a couple of weeks later. Okay, it takes a few weeks to accomplish. Of course, we are talking about a weekly chart, right? The volume behavior, as I haven't told you, is usually lower between these points, okay? See how the volume decreases when we approach to the highs, and volume should be strong during the neckline break. And we have that here, okay? Again, if we have pullbacks, this volume should fall, but as usually, as I was telling you about, it's hard to see pullbacks in Japanese yen crosses, right? It's more pair that when Japanese yen is a currency that once it catches a trend, it doesn't look back, right? It doesn't turn back to make pullbacks, but to confirm, right? I do like pullbacks, in fact, in the other pairs because they are kind of confirmations of what is happening in the market, right? If we saw this high volume break, okay, we don't know where to enter. Maybe if we turn this kind of chart to a daily and we see a daily candle opening under that, we are talking of a weekly, right? We turn to one smaller time frame, right? We can wait for, I don't know, maybe a daily candle open under that level to confirm an entry. Let's see what happens and if we can see it, okay, in the daily without losing much of the figure, right? Here we are, okay? Here are with the break. See what happened? We could enter here around 217.32. That's our entry point, okay? But it's better to see usually the pullbacks, right? Because if the pair rise again to test the neckline and fail to regain it to the upside, that will be a further confirmation of the movement and of the figure. It will give me a more profitable signal, okay, more accurate signal. But of course, that usually happens mostly with euro and GDP, not with Japanese yen crosses, okay? Okay, and once we are approaching to our target, okay, once we are approaching to our target, we said that volumes tend to increase again, okay? That's what the formation has. Of course, as usual, stop loss should be placed above the neckline, okay? And regarding the time frame we are trading, that's where we should place our stop loss, okay? We have another example here in the, sorry, let me find the chart, okay, here, in the 4-hour charts in euro, okay, here we are. Here we have another example of a head and shoulders in euro, right? Maybe not the most accurate figure, maybe not the most clear one, but it's here, okay? We have a second shoulder slightly higher than the first one, okay? This candle spike, okay? We have a head in the middle at a higher level, and we could talk about a neckline around that zone, okay? This minimum, and this, okay? Again, the profit in this figure would be around 230 pips and well, of course, the pair accomplished them. Okay, if we move to smaller time frames, 4 hours, 1 hour time frames, it's more easy to see pairs accomplishing the 100% of the target. Okay, but in bigger time frames, more than 4 hours, when we are talking about dailies or weeklies, I tend to reduce that limit. Okay, or at least move the stop loss. Right. In this case, our stop loss should be around 50 pips above the neckline, right? We have I was trying to watch for the example. I couldn't find it. We had a previous. I don't want to mess with charts too much and move them too much because I know that won't be good for you. In this case here, okay, we have another head and shoulders, right, in 4 hours charts, and we are at the end of a bullish trend. So see what happens here, 180 pips, the pair reach 140, right? See why we need to reduce our limit a bit. But I was trying to look for a failed one. We have a few days ago in euro, right? We have a great head and shoulders formation. I can't remember how long away. I have been trying to find the example, but I couldn't. Maybe it's longer than I believe. Yeah, anyway, the pair failed to accomplish the sorry, not only failed to accomplish the target, but in a couple of candles, right, after the break neck, okay, a couple of candles. At first, the break was not this with this high volume, and a couple of candles after breaking the neck, the pair regained the neckline and opened a candle above it and start an upside rise. Okay, and that's something we should quickly discard and close our positions. Right? We couldn't wait and hold to see if it comes back. That's something that we should forget about in Forex markets. Right? It will come back, and I could wait. All that prices fall and all the such comments usually tend to destroy accounts. Anyway, we are in this forward charts, and we have here another example of a double roof, okay, with a break of the neckline, okay, and the pullback, right? We have here a clear pullback. Let me mark the zone and enlarge a bit the figure, right? Chart so we can see it more. Okay, here we are, okay. We have two highs at the same level, a neckline, okay, a candle opening under, okay, and a pullback price. It attempts to regain the level, but never manages to open a candle above. I do believe that I will enter this figure and watch for the candles closing, right? In this case, we have a strong acceleration when the pair starts running for their target, as it should happen regarding volume, okay? So, yes, Abel, I know there's different people usually, we have different concepts about drawing necklines or trend lines, right? I tend to draw everything in the candle wicks rather in the candle bodies, okay? I don't take care of where the price candle close or opens, okay? I go for the highs and the lows of the day to draw my necklines, to draw my supports and resistance levels, right? If I had to draw a trend line, okay, just as an example, okay, I would take these highs, right? I have 1, 2, 3 highs here, right? That's what the trend line needs, 2, 3 points, and once it breaks, well, it moves to the upside. That's the concept. But I do know there are many people that rather draw trend lines regarding the bodies, okay, of the candles and not the wicks, like in this case. See that I take the opening of this candle, the opening of this one to draw the trend line. It's I believe that's a matter of taste, you know. I do believe that it's something we should people like, but for me, it's just wicks, okay, it's just highs and lows. Those where the price is hot, right? That's what I prefer to mark, okay? And of course, if we had, let me find it here, okay? If you see head and shoulders, I have the channel in here, and that's not what I'm looking for. Okay, if we had a head and shoulders in the in the euro, we will find out an inverted head and shoulders in Swiss franc, no doubt. Let me see if I can find a clear example. But anyway, we have here, see the example of the 324 floor in the forward charts in here with the neckline around this level. Okay, those are quite reliable figures. We see them everywhere. Okay, here we have. Let me mark it and enlarge it for you. Okay, here we are. This is what we call an inverted head and shoulders, right? It's exactly the same of a head and shoulders, of course, but it's at the end of a bearish trend, and of course it's inverted to the other one we were talking about. Okay, it's typical of the bearish market, so it will mean a bullish correction, and of course it's also a high reliable figure. It's quite common, but less common than double roofs or double floors or triple walls, right? And again, we have three minimums area, right? One here, another here, and in the middle, the clearly lower head, right? In this case, and of course, it's better if it has a slightly bearish slope. Okay, in this case, it's not the most accurate formation as we have a slightly bullish slope in this case, right? See, the second shoulder has a slightly bullish slope, so maybe not the most reliable formation. What I do take care of these formations in Swiss franc and euro is that once we saw one in one of the charts, they tend to behave parallel, we can seize the opportunity and watch for the inverted figure in the other charts, right? But maybe this is not the best figure, but at least it accomplished its target and finally worked. Meaning, not being the best doesn't mean it's a wrong figure, right? It's better if it has a very slightly bullish slope, bearish slope, or horizontal one. Okay, in this case, it's less reliable because we have a bullish slope. Okay, anyway, see what happens when price breaks the neckline. Okay, the formation is complete. The bullish target will equal the distance between the neck and the high of the head, right? And see how volume increase when we break. See, it's almost everything. It's always mostly is that's what guides us. Okay, when we have this kind of formations and how we get into the market in these cases, we should turn to 1 hour charts. Okay, to smaller time frames. Okay, like this one, right? And maybe wait for a candle opening. Okay, above the neckline. Okay, to enter the market and go for the right? That's the way we should do it. Reduce one time frame and wait either for the pullback or enter in a new candle opening. Okay, that's something we should decide. Sometimes not so easy to do. Okay, because you don't know when a pair is going to accomplish a pullback or not. The fact is that euro dollar and GBP dollar tend to accomplish pullbacks 80% of the time, and not the rest of the pair. So depending on the pair you're trading, you can use that to decide to wait or not for a pullback. Okay, and another thing that's important is that I tend to watch very much supports and resistance levels, right? We need to take care of supports and resistance levels in all pairs. Okay, so I'd rather wait for a break of an important resistance or important support zone to get into the market, right? In this case, we have those highs around 760 previous, okay, higher than the neckline, okay? And if we take a look to the past, we will probably find out that around this zone, we have a tough resistance support area. Even this day, it has been before the pair falls to for 20 words right now. But anyway, I tend to watch that, okay? So once that resistance is surpassed and the candle opening is above that level, well, no doubt the pair will continue accelerating, okay? I pay too much attention to the resistance and supports, and I place my stops under them, or above them regarding where the figure is. Okay, so okay, on trade lines, have you tried the marks? No, I don't. About take a look at dollar, at Cabo dollar. Yes, that's what do we have there? What do you want to see there regarding our friend GBP daily 4 hours? What's your question, Chess, about cable current figures? Okay, I'm waiting. What do you know? Want to know about our friend cable? Okay, daily charts. Yes, kind of we have kind of a head and shoulders here, right? But they are never managed to break the first neckline, the level, and we are forming here kind of a second shoulder. I don't like this formation very much. I would love to see the pair break into the downside when it's reached that level, but it's failed, so it's not the most accurate figure, okay? But at least the two shoulders have a slight bullish slope as it should, okay? Maybe if we consider this the neckline, okay, we could call this support fail figure, right? As the pair candle, open a candle here and change BS, right? So this one probably could be understood as failed one, but I was not really following this as a figure. I don't know why. I read some comments about this, but the fact is that GBP has been in a range between 61 and 62, 66.60 so for so long. I don't dare to trade any breaks to the downside at least until it breaks at 160. So you have to combine not only the figure, okay? We know that one till is not enough to trade, right? Not the figure alone, okay? We need to see further market signals, okay? Or maybe think a bit when we are trading, okay? If we are talking about this particular or probable figure that was forming in here, okay? The fact is that the pair has been range bound since June, so I use my logic and I won't enter the pair selling at this level for I don't know, the number of pips were 800 pips, right? I would like to see it under these minimums around 60, right? Call for a bearish strongest movement, or above 67 to call for a bullish one. But I need to see the pair out of range also. Okay. We could also add different indicators to measure if the pair is oversold or overbought when it reaches the neck. One completes the formation and attempts to break. Okay, so if we have to wait a bit, well, we need to wait a bit. Better not gain the first number of pips the figure has than lost them all. Okay, so that's something we should take care of. But yes, enter below the low of the lowest week. Okay, in this case, if we are following this formation, maybe the zone, okay, this minimum here and this minimum here will be the neckline, okay. But as you can see, well, that's something we were talking about with GBP, okay. We have not high volume of the break. We have a pullback, but the candle close above the neck. We have these formations here that no doubts are not making the figure quite clear, because the pair should have complete the pullback and quickly round to the downside, and it didn't, right? So that's not a good signal of a break of the neck. See difference between the high volume, the pullback. In this case, we have no high volume in the break. The pullback is not such. The fact is that pair remains consolidating around that zone, opening a candle, never manages to move away from that neck. Okay, but yeah, if you enter the market, that's a failed figure, right? And this red candle, no doubts, should have stopped us away and take us out of market. Okay, nothing in Forex market is 100% reliable. You know that. Not even figures. Anyway, if you have any questions, you can make them now, because I do believe this is the end for today. we will continue next week or so, right? With next month probably with the rest of our figures. Okay. No questions? No comments? Okay. So this is the end. Thank you for being here. I will leave you, as always, my messenger address, so you can talk to me whenever you want to. Okay? And I hope to see you all tonight at my daily live webinar at 23:30 GMT. Okay? We will review live what's going on with the market there. Okay? So, hi, Elena. Long time without seeing you. Hope to meet you at the ITC. Thank you all, really. It's a pleasure for me to be here. Right? Okay. Yes, same. Okay. Bye for now. See you. Bye-bye. Thank you, really.